Well, if you go back in that cycle, you can see you have big corrections. And I try to relate this also my Jets airline ETF. After SARS, in 6 months, it went up 120%. But there were four times of corrections of more than 10%. So I just think investors have to be able to stomach that we're going to get these big corrections.
Okay. Now, Frank, in 2008, we saw a huge run up in the dollar index from the second half of 2008 to the beginning of 2009 before it came back down in 2009. We saw a bit of an uptick in the dollar index earlier this year before it went back down, and now it's sort of flatlining. But if you look at the pattern in the charts that you sent, we're not seeing the exact same correlation of the Fed balance sheet expansion in the dollar index now, especially in the second half, Q2 of 2020. Why is this connection not taking place now as it did back in 2008?
Well, we started seeing it last year on global trade, and everything's traded in dollars. And all of a sudden, there was a shortage of dollars. And that was probably a factor that was leading to a stronger dollar on a relative basis. So the Fed has had to step in and do these massive repos to stabilize the financial markets outside of America for trade. And I think they've already exhausted that end. And now what they're doing to spur economic activity, which is unprecedented. They're buying ETFs. They're buying bond ETFs. They're buying corporate bonds. They're doing everything to get and maintain interest rates, not just corporately, but also from the government, low to negative, so that they can get this economic engine turn. And I think bad news ends up being, good news for, you look at the world of gold, because the government's going to continue to print money.
Okay, so where do you see the dollar headed from here, Frank?
Well, I think over the next 3 years, it's going to have a correction that's inversely related to the $4,000 run.
All right. Okay. If we look at inflation too, do you see an inflationary event over the next 3 years, or can we expect disinflation?
Well, no doubt we're going to have some disinflation. The CPI numbers have collapsed. But what will happen, I think, is that CPI numbers are going to start to creep up as purchasing manufacturers index has rebounded, as it has done already in Asia. And we start seeing people flying again, people doing economic activity again, and that will start raising inflation. And so I think what will happen is the government will be slow and reluctant to raise rates while CPI trades higher, and therefore more and more government bonds have negative real rates of return. And this, remember I said, to synchronize the cartel of the G20 finance ministers. That means we're going to get in a scenario which was greater than last August, when there's so much negative real bonds around the world. That will soar gold to over 2,000.
2,000 in what timeline?
Well, I think by Christmas.
Okay. Now, if gold is going to climb by more than 150% over the next 3 years, according to your projections, what's going to happen to gold miners in the same period?
Well, those gold miners would show discipline in their production, their cash flow, and have a higher returns on invested capital. Those signatures will attract the generalists. The generalist is going to look for those stocks that can show growth in revenue, can show growth in cash flow, or capacity to pay a dividend. They'll be rewarded handsomely. The ones that don't, they're the ones that'll be punished. Now, what's good is that this past March quarter, that the gold universe we follow went from a negative free cash flow yield a year ago to a positive, while the rest of the S&P collapsed. So I'm very bullish on many of these quality gold stocks.
I remember we spoke a few weeks ago, and you had said to me that in order for gold stocks to rise, we need both a rally in gold and broad equities in general. We've already talked about gold. What do you think about equities? I've been reading some reports, and data has come in suggesting that people are defaulting on the rent, and some analysts are concerned about a possible correction in the housing market, potentially a bust on the scale of 2008. Do you think that's a legitimate risk?
No, it was a very different credit profile back then and today. And housing starts and housing sales, new home sales, was on a tear. So you to qualify for a mortgage today is totally different than 2005, 6, 7, 8. I mean, it was a 1% down. It's a much higher hurdle rate today to be able to go buy a new home. So I think it's not as bearish as people are looking at, but we got to remember what's happened that's very different today is that you have these central banks that, like Switzerland, that go and raise money. They don't go and buy bullion like before they used to. They buy stocks. They buy Apple because the dividend yield is higher than what they have to go and pay. So they can create this funny money with this negative real rates return. They're going buying Nestle's. They're buying quality blue chip stocks around the world. They own 15% of their own stock market. The same thing has happened in Japan and other countries. So I think there's a real difference of government and government agencies playing a bigger role in the capital markets, which has always historically been a bullish sign for gold.
Yeah, Frank, we've seen a huge run up in stocks since March lows. At the same time, we've seen really historic levels of new brokerage accounts open, especially the online brokers, Schwab, Robinhood. Do you think there's a connection there?
Well, I think it's so important when the numbers are suggesting that all these new millennials coming in through the Robinhoods of the world, through the Schwabs and TD Waterhouses, that they surpassed investing in the market than stock buybacks on the S&P 500. So that was an unprecedented number. But to really have a healthy ecosystem, you have to have minnows. You have to turn around and not just have a bunch of whales price bidding against each other. And the same thing happens in the ocean and happens in capital markets. So I think it's a breath of fresh air that we're getting millions of new people that are coming in and speculating. They've been stuck at home. And all of a sudden, what's different than the 90s is that they have the internet and they're more sophisticated. They use it and they use YouTube and podcasts. They use KitGo. They'll follow your interviews here and they're more informed. And I think it's also exciting when you go to Robinhood and you see for gold investors along the toolbox basically is a category gold. There's no category like that when you're looking at Schwab or you're looking at TD Waterhouse. So that millennial investor is very curious and interested in learning more about gold as an asset class.
Are you at all concerned about the amount of leverage that millennial investors are taking today? We've seen different trading patterns between millennial investors using online brokerages and the past generation. And another note is that, have you ever wondered why or where they're getting the money in the last couple months to be investing? We've seen at the same time savings rate go up enormously. Where are people coming up with this extra disposable income for investing in the stock markets?
Well, it's the big coronavirus bailout. Come on, it was the consumers. It was a massive bailout. In fact, I would look at the $25 billion for the airline industry as much more of a quick form of unemployment insurance. Keep everyone working and the economy turns, they don't have to rehire, they immediately are flying again. And data is now showing that the close to 80% of those checks they received went into the stock market. So you're seeing it coming back into the capital markets. And I think at low interest rates, there's a hunt for stocks that have growing dividends. Well, you take a look at the royalty companies, beautiful growing dividends, much higher than earn in a money fund.
These millennials are buying tech stocks. They're buying, retail stocks, online companies. They're not really buying gold as much as gold bugs are.
I would say to you that it's really shocking. If you look at the GDX growth or my GoAU ETF, it's like this with the stock price of new millennials coming in. And when you take a look at the JETS ETF, it halved and in end of February. And all of a sudden now we have 40,000 investors through Robinhood alone that have come in. And most of those people have caught the big first run up in the airlines industry. So I wouldn't be so bearish. I know Forbes had an article about some young kid that read his statements, committed suicide, but I'm told that he misread his statements because he had some sophisticated straddle on. But what's interesting is if that kid had made that amount of money, would have gotten the same publicity? No, it wouldn't have. So the whole thing here is this really interesting. The general mainstream media is very negative on retail people coming into the stock market, which is sort of un-American.
Yeah, that's a good point you brought up. And actually, I had a few friends of mine call me up and say, hey, is now a good time to buy gold? These are millennials who have not been interested in the metal before. And you've just talked about your Go AU. Why the interest now from an age group that previously had really just ignored this sector?
Well, good income. A lot of them making good income. They're still getting paid while they've been at home. And they can't go to bars. And it's only recently they couldn't travel. They're very sophisticated in knowing how to get the cheapest holidays and flights and hotels. So all that's shut down, and they took that intellectual energy and put it into the stock market. I think that's very positive, very constructive for overall capital formation.
Finally, Frank, we're entering July now. How do you feel about the stock market and the economy? Is the recovery giving you confidence as an investor?
Yeah, I think the amount of money being printed is so simple. If you look at the trillions have gone in, it's so self-explanatory why the stock market's gone up. And then you add on the minerals coming in, which is billions and billions of dollars flowing into it. What's different? What's so different than 20 years ago, 30 years ago? It's zero interest rates. It's negative real rates of return. So all of a sudden, the stock market becomes a quasi-gold as a real asset. It's a real business. And that's what the Swiss have been doing, buying real businesses and getting those dividends. So I think that this is the paradigm shift. When I first moved to Texas 30 years ago, money market yields were 8%. We're not talking about 8 basis points now like they are today. So dividend paying stocks or opportunities to pay dividends and grow. That's the big paradigm shift change.
All right, fantastic. Thank you for your thoughts today, Frank. I appreciate you coming out of your, taking time to come on the show today.
And remember that gold historically falls in June, and it's usually a good time to buy for